Preparing a Sustainability Report Part 2 of 5. Welcome. The Sustainability Report is an important tool to help an organization communicate effectively with its stakeholders. In this course, you will learn about sustainability reporting, Singapore Exchange's Sustainability Reporting Guide, and how to implement the guide in practice. The course starts with providing you an understanding of corporate sustainability. The course will then take you through a step-by-step approach from planning to developing a sustainability report. You may access the SGX's Sustainability Reporting Guide on the link provided on the screen for more details. There are 5 topics in this course which will take approximately 90 minutes to complete. You can access any of these topics in the Preparing a Sustainability Report playlist available on the SGX Group channel. Topic 2: Sustainability Reporting Frameworks. This topic introduces the various reporting frameworks available in the market for sustainability reporting and elaborates on 4 international reporting frameworks, namely the Global Reporting Initiative Standards, the Sustainability Accounting Standards Board Standards, the International Sustainability Standards Board Standards, and the Task Force on Climate-Related Financial Disclosures Recommendations. After which, the topic describes recent and upcoming developments in sustainability reporting. As covered in Topic 1, Sustainability Report is a tool for organizations to communicate their strategy, management, and performance of environmental, social, and governance aspects. How these information are presented can affect business decision-making and stakeholder relations. There are various globally recognized reporting frameworks available in the market that provide guidance on disclosing these information and developing a sustainability report that is relevant, reliable, comparable, and transparent. Reporting frameworks provide guidelines that define the reporting approach and content, such as report scope, sector-specific disclosure items, and performance metrics for sustainability reporting. Reporting frameworks also set out some common guiding principles around materiality, conciseness, reliability, and completeness, as well as consistency and comparability. SGX requires listed issuers to select a sustainability reporting framework or frameworks to guide their reporting and disclosure and explain their choice. Some of the commonly used international ESG reporting frameworks by corporate reporters include the Global Reporting Initiative Standards and the Sustainability Accounting Standards Board Standards. These will be elaborated in the later section. There are also reporting frameworks that are specific to industries or thematic ESG issues. For example, the Global Real Estate Sustainability Benchmark is a framework specific to the real estate sector. The Roundtable on Sustainable Palm Oil is an example of a thematic reporting standard. There is also the UN Guiding Principles Reporting Framework, which provides comprehensive guidance for companies to report on how they respect human rights. Moreover, the Task Force on Climate-Related Financial Disclosures provides recommendations to help issuers disclose clear, comparable, and consistent information about climate-related financial disclosures. An issuer should select the reporting framework that is most suitable for its industry and business model. It may choose more than one framework if appropriate. The issuer should also state the name of the framework, explain its reasons for choosing it, and provide a general description of the extent of the issuer's application of the framework. The GRI standards were revised in 2021 to, among others, provide greater clarity on key concepts, reporting principles, and disclosures in the GRI standards, encourage more relevant and comprehensive reporting, and improve the overall usability of the GRI standards. The updated modular system of the GRI standards consists of 3 series of standards: the GRI Universal Standards, which apply to all organizations, the GRI Sector Standards, applicable to specific sectors, and the GRI Topic Standards, each listing a set of disclosures relevant to a particular topic. The updated standards comprise of 3 universal standards, namely, GRI 1, Foundation 2021, GRI 2, General Disclosures 2021, and GRI 3, Material Topics 2021. 40 sector standards. The GRI Sector Program will develop standards for 40 sectors, starting with those that have the highest impact. GRI sector standards have a double-digit code number. The first GRI sector standard, GRI 11, is for oil and gas. It was launched in October 2021 and came into effect for reporting in January 2023. The sector standards for coal, GRI 12, and agriculture, aquaculture, and fishing, GRI 13, have also been released and were effective from January 2024. More sector standards are currently under development. An organization may use the sector standards for its sectors to determine and report on their material topics. There are 31 topic standards. Topic standards have a 3-digit code number. An organization selects topic standards corresponding to its identified material topics and uses them for reporting. The GRI topic standards contain disclosures providing information on various topics, such as waste, occupational health and safety, and tax. There are 2 options to using the GRI standards: a report that references the GRI standards, and a report that is in accordance with the GRI standards. GRI recommends reporting in accordance with the GRI standards. Under this approach, the organization reports on all its material topics and related impacts and how it manages these topics. Alternatively, organizations can report with reference to the GRI standards if it is unable to fulfill some of the requirements to report in accordance with the GRI standards or only wish to report specific information for specific purposes, such as when complying with regulatory requirements. An organization may choose the appropriate option that fits the organization's reporting objective and maturity. For the topic standards, the GRI standards have outlined the specific disclosures for reporting by providing detailed guidance on the information required to comply with the standards. The standards include the following components. Firstly, requirements. This section provides mandatory instructions to comply if you are reporting in accordance with the standards. The requirements are to be read with the recommendations and guidance. Second, recommendations. The instructions provided in this section are encouraged but not mandatory. And third, guidance. This section provides the background information and examples to help organizations to better understand the requirements. SGX requires 6 primary reporting components to be incorporated within a sustainability report. The GRI standards largely align with the reporting components required by SGX except for climate-related disclosures consistent with the TCFD recommendations, targets, and board statement and associated governance structure for sustainability practices. On climate-related disclosures, SGX requires sustainability reports to contain disclosures related to climate risks and opportunities, consistent with the TCFD recommendations. Conversely, the GRI standards do not mandate climate-related disclosures. On targets, SGX mandates that the sustainability report should set out the issuer's targets for the forthcoming year in relation to each material ESG factor identified. Targets should be considered for defined short, medium, and long-term horizons, and if not consistent with those used for strategic planning and financial reporting, the reasons for the inconsistency should be disclosed. On the other hand, the GRI standards do not prescribe a 12-month timeframe for targets but instead require the organization to disclose future short and medium-term targets. If the targets have been established, SGX also says that the sustainability report should contain a statement of the board that it has considered sustainability issues in the issuer's business and strategy, determined the material ESG factors, and overseen the management and monitoring of the material ESG factors. In addition, the sustainability report should describe the roles of the board and the management in the governance of sustainability issues. The GRI standards only require a statement from the most senior decision maker. Another reporting framework available in the market is the Task Force on Climate-Related Financial Disclosures. The TCFD recommendations aim to promote more informed investment, credit, and insurance underwriting decisions through better reporting of climate-related risks and opportunities. The recommendations are structured around 4 thematic areas that represent core elements of how organizations operate: governance, strategy, risk management, and metrics and targets. The International Sustainability Standards Board, or ISSB, issued its inaugural IFRS Sustainability Disclosure Standards in June 2023. The ISSB standards allow companies and investors to standardize on a single, global baseline of sustainability disclosures for the capital markets. The two standards are namely, the IFRS S1 on general requirements for disclosure of sustainability-related financial information, and IFRS S2 on climate-related disclosures. The ISSB has provided reliefs from some requirements in the first year a company applies IFRS S1 and IFRS S2. The objective of IFRS S1 is to require an entity to disclose information about its sustainability-related risks and opportunities that is useful to users of general-purpose financial reports in making decisions relating to providing resources to the entity. IFRS S1 requires an entity to disclose information about all sustainability-related risks and opportunities that could reasonably be expected to affect the entity's cash flows, its access to finance or cost of capital over the short, medium, or long term. In particular, an entity is required to provide disclosures about the governance processes, controls and procedures the entity uses to monitor, manage and oversee sustainability-related risks and opportunities. The entity's strategy for managing sustainability-related risks and opportunities, the processes the entity uses to identify, assess, prioritize and monitor sustainability-related risks and opportunities, and the entity's performance in relation to sustainability-related risks and opportunities, including progress towards any targets the entity has set or is required to meet by law or regulation. IFRS S1 also sets out some conceptual foundations. First, on fair representation, a complete set of sustainability-related financial disclosures shall present fairly all sustainability-related risks and opportunities that could reasonably be expected to affect an entity's prospects. Second, on materiality, an entity shall disclose material information about the sustainability-related risks and opportunities that could reasonably be expected to affect the entity's prospects. In the context of sustainability-related financial disclosures, information is material if omitting, misstating or obscuring that information could reasonably be expected to influence decisions that primary users of general-purpose financial reports make on the basis of those reports, which include financial statements and sustainability-related financial disclosures, and which provide information about a specific reporting entity. Third, on reporting entity, an entity's sustainability-related financial disclosures shall be for the same reporting entity as the related financial statements. Last, on connected information, an entity shall provide information that enables the users of general-purpose financial reports to understand the connections between various sustainability-related risks and opportunities that could reasonably be expected to affect the entity's prospects, its disclosures on governance, strategy, risk management and metrics and targets, and its sustainability-related financial disclosures and its related financial statements. IFRS S1 prescribes how an entity prepares and reports its sustainability-related financial disclosures. It sets out general requirements for the content and presentation of those disclosures so that the information disclosed is useful to users in making decisions relating to providing resources to the entity. Entities shall apply IFRS sustainability disclosure standards in identifying sustainability-related risks and opportunities that could reasonably be expected to affect an entity's prospects. There are 5 general requirements outlined in IFRS S1 for disclosures of sustainability-related financial information. First, on sources of guidance, in addition to the IFRS sustainability disclosure standards, an entity shall refer to and consider the applicability of the disclosure topics in the SASB standards. An entity might conclude that the disclosure topics in the SASB standards are not applicable in the entity's circumstances. In addition, an entity may also refer to and consider the applicability of other relevant frameworks or standards. Second, on the location of disclosures, entities are required to provide disclosures required by the IFRS Sustainability Disclosure Standards as part of its general-purpose financial reports. Third, on the timing of reporting, entities shall report its sustainability-related financial disclosures at the same time as its related financial statements. And such disclosures shall cover the same reporting period as the related financial statements. Fourth, on comparative information, unless another IFRS sustainability disclosure standard permits or requires otherwise, entities shall disclose comparative information in respect of the preceding period for all amounts disclosed in the reporting period. If such information would be useful for an understanding of the sustainability-related financial disclosures for the reporting period, the entity shall also disclose comparative information for narrative and descriptive sustainability-related financial information. Fifth, on the statement of compliance, entities applying the IFRS sustainability disclosure standards shall make an explicit and unreserved statement of compliance. The objective of IFRS S2 is to require an entity to disclose information about its climate-related risks and opportunities that is useful to users of general-purpose financial reports in making decisions relating to providing resources to the entity. IFRS S2 sets out specific climate-related disclosures and is designed to be used with IFRS S1. IFRS S2 requires an entity to disclose information about climate-related risks and opportunities that could reasonably be expected to affect the entity's cash flows, its access to finance or cost of capital over the short, medium or long term. These include climate-related risks to which the entity is exposed and climate-related opportunities available to the entity. IFRS S2 sets out the requirements for disclosing information about an entity's climate-related risks and opportunities. Similar to IFRS S1, it requires an entity to disclose climate-related information about governance, strategy, risk management, and metrics and targets, including any climate-related targets it is required to meet by law or regulation. The objective of IFRS S2 is to require an entity to disclose information about its climate-related risks and opportunities that is useful to users of general-purpose financial reports in making decisions relating to providing resources to the entity. Some of the key disclosures an entity should make under IFRS S2 are as follows. First, it should disclose the effects of climate-related risks and opportunities on the entity's strategy and decision-making. Second, the entity should also disclose the effects of climate-related risks and opportunities on its current and anticipated financial performance, financial position, and cash flows. Third, the entity should demonstrate the resilience of its strategy and business model to climate-related changes, developments, and uncertainties. Fourth, the entity should provide its absolute gross Scope 1, Scope 2, and Scope 3 GHG emissions. Fifth, the entity should disclose the climate-related targets it has set, as well as those it is required to meet by law or regulation. Another reporting framework available in the market is the SASB standards. The SASB standards are designed to be used to communicate to investors the sustainability issues that are likely to impact an organization's ability to create value over the long term. An organization can use the SASB standards to better identify, manage, and communicate to investors sustainability information that is financially material. SASB standards can help investors by encouraging reporting that is comparable, consistent, and financially material. In August 2022, the IFRS Foundation assumed responsibility for the SASB standards when it merged with the Value Reporting Foundation, which previously maintained these standards. SASB S77 industry-specific standards provide a complete set of globally applicable industry-specific standards which identify the minimal set of financially material sustainability topics and their associated metrics for the typical company in an industry. Each SASB standard describes the industry that is the subject of the standard, including any assumptions about the predominant business model and industry segments that are included. SASB standards include disclosure topics, a minimum set of industry-specific disclosure topics reasonably likely to constitute material information, and a brief description of how management or mismanagement of each topic may affect value creation. Accounting metrics, a set of quantitative and/or qualitative accounting metrics intended to measure performance on each topic. Technical protocols. Each accounting metric is accompanied by a technical protocol that provides guidance on definitions. Scope, implementation, compilation, and presentation, all of which are intended to constitute suitable criteria for third-party assurance. Activity metrics, a set of metrics that quantify the scale of an organization's business and are intended for use in conjunction with accounting metrics to normalize data and facilitate comparison. The tables illustrate extracts from the SASB standard for oil gas exploration and production. For example, greenhouse gas emissions is an industry-specific disclosure topic. An organization can adopt the technical protocol prescribed in the standard for specific disclosure on its greenhouse gas emissions and refer to the activity metrics for key related business activities. In general, an organization may use the SASB standard specific to its primary industry. An organization with substantial business in multiple industries can consider reporting on additional SASB industry standards. An organization can determine the use of the standards, including the disclosure topics that are financially material to its business and the associated metrics to report. In recent years, growing interest in ESG has led to a proliferation of sustainability reporting frameworks. There is a strong desire to address a fragmented landscape of voluntary, sustainability-related standards and requirements to both companies and investors. In November 2021, the trustees of the IFRS Foundation announced the formation of the International Sustainability Standards Board. The ISSB is developing standards that will result in a high-quality, comprehensive global baseline of sustainability disclosures focused on the needs of investors and the financial markets in the public interest. To deliver this global baseline of standards mentioned earlier, several sustainability disclosure organizations have been consolidated by the IFRS Foundation. In January 2022, the Climate Disclosure Standards Board, CDSB, was consolidated from the CDP into the IFRS Foundation. Later in August 2022, the Value Reporting Foundation, which houses the Sustainability Accounting Standards Board, SASB, and the International Integrated Reporting Council's, IRC's, Integrated Reporting Framework, was consolidated into the IFRS Foundation. The IFRS Foundation oversees the ISSB, which builds on the recommendations of the Task Force on Climate-Related Financial Disclosures, TCFD. The GRI, a widely used reporting standard by SGX-listed issuers, has also signed a Memorandum of Understanding with the IFRS Foundation to work together and seek comparability between the IFRS standards and the GRI standards. Let's pause for a quick knowledge check. Which statement is true? You may pause the video now, jot down the answers, and when you are ready to continue, press play. An issuer should select the reporting framework that is most suitable for its industry and business model and that allows stakeholders to have a better insight of the issuer. In certain cases, an issuer may use more than one reporting framework to suit the issuer's needs. SGX Sustainability Reporting Guide does not prescribe any reporting framework for sustainability reporting. The guide requires an issuer to select globally recognized reporting frameworks. Congratulations! You have completed Part 2 of 5 of the course on preparing a sustainability report. You may access the third module on materiality and stakeholder engagement from the playlist available on the SGX Group channel.